We're going to continue our conversation of capital budgeting by looking at cash flows. When we look at a capital project, decide if we're going to accept the project or not, all we're worried about is the incremental cash flows, the additional cash flows that will come from the acceptance of the project. We will do that through pro forma financial statements. We are going to calculate the cash flows by predicting or estimating the future cash flows. We will be looking at operating cash flows, primarily operating the asset or installing the asset and generating cash flows from it. Sometimes we'll be looking at a replacement decision. We have a current project in operation. Should we replace it with a new project or a new asset? And then we will again evaluate it through the discounting of cash flows. A few cash flows that are common are sunk cost. Those are the ones that have already been accrued in the past. We've already spent the money. These will not be evaluated in the decision process. Opportunity cost, those would be anything that we would lose if we were to accept. We could install a machine in a building, or we could lease the building. The leasing of the building would be the opportunity cost. Change in net working capital would be example of inventory. If we install this asset, would we have to increase our inventory? If so, we would have to spend money on those assets called inventory. Financing cost, how much does the money that we are going to use to buy the asset going to cost us? That would be your cost of capital. And we also must always take into consideration taxes. So let's do a quick example. We need to look at the net investment. This would be the cash flow at year zero, and that would include cost of assets, installation of the asset, change in net working capital, sale of any old asset if it's a replacement, tax on the sale, all of those added, and you can see plus or minus. We just have to evaluate whether it's going to be a positive or a negative cash flow, and the net investment would always be an outflow, our expenditure. The incremental cash flows from operations would come from the change in, because these are incremental, the change in expenses, the change in depreciation, the change in EBIT, the change in taxes, the change in net income, which would give us the change in net cash flows. And I'll just put the triangles down in your mind. These are incremental, or the change in. The same for the salvage value. If we have the ability to sell it at the end, the terminal period at the end of the life of the project, we have a salvage. Anytime we sell something, there's a potential for tax, which would give us our terminal or salvage value. Project X, it's a new project. If we take this on, revenues will increase by 50,000, expenses will increase by 20,000. The asset will cost us 100,000. The installation cost is 20,000. The tax is 21%. We're going to use 5-year straight line depreciation, which we will work with in more detail. But just to look at this real quick, I will post this sheet in the As You Learn. Maker's depreciation is modified accelerated cost recovery system. If it is a Maker's 3-year property or asset, then we would depreciate it over 4 years, a half year the first year and a half year the fourth year. And we would use this table. We would depreciate this amount each year, 5 years. We would depreciate over 6 years, 1/2 year the first year, 1/2 year in the 6th year, which gives us a total of 5 periods or 5 years. And this is given to us by Congress. So these charts will always be provided for you. And again, straight line, 5-year, just means 20% each year. If it were 3 years, it would be 33.33% each year. 10-year would be 10% each year. These tables just determine the amount that we can write off each year. Let's just go through this. Project X, First, we will deal with the year 0 cash flow, the net investment. The asset cost is $100,000. The installation is $20,000. There is no change in net working capital. There's no old asset because it's a new project, so therefore there is no tax. The net investment is $120,000. We will need to raise capital or have capital of $120,000 in order to invest in Project X. Revenues increase $50,000. This would be per year. Expenses $20,000. Depreciation will be straight line 5-year. So we would depreciate the entire installed cost. So the entire installed cost would be $120,000 divided by 5 equals $24,000. That would be 50 minus 20 minus 24 would be 6,000. The tax on that at 21% would be $1,260. The net income modified because we're not taking out the interest expense because we're looking for the cash flow that's available to all stakeholders or investors. So we're going to subtract 6,000 from 1,260 and get 4,740. The depreciation was set aside, was subtract from the cash flows in year 1. The money was spent in year 0. So this is a non-cash flow in year 1. This money was not spent here. It was spent way back at year 0. So the government says you can set this aside, this amount, based on a 5-year straight line method. So we can not pay tax on $24,000. So that money did not go away. We just took it out long enough to pay the taxes. So it is still available for the companies to spend or to use in year 1. So the cash flow is $28,740. Since this is straight line, how is this going to be different in year 2? It's not, because the straight line depreciation will make the depreciation in year 2 $24,000, in year 3 $24,000, year 4. So this cash flow stream will look exactly the same year 1 through 5. In year N, there is no salvage, therefore there is no tax. Year N, or the salvage value or terminal value, is 0. So we can now take those cash flows and write down all of the cash flows associated with this project, and you'll notice that looks just like what we've used before. And this was what we do the net present value on. The criteria that you would have to be able to do after you do the cash flow, the only one that you are required to calculate is net present value. And if the net present value, let's say the cost of capital is 10%, what is the net present value? We would put in 5N, the I is 10, the present value is what we're calculating, the payment are $28,740, the future value is 0, the present value is $108,947 $1,000,000.21. That is the present value of the inflows minus the present value of the outflows, which was $120,000. $120,000 minus 108,947.21 equals 11,052.79. This would be a negative number. So this is a bad project and we would reject. The point here is we can now calculate the cash flows at year 0 and over the life of the project, then evaluate those using our criteria. So what you want to concentrate on is calculating the cash flows, the incremental cash flows, the ones that we will receive because we accepted the project above and beyond what cash flows we would have without the project. And that is your introduction to cash flows for capital budgeting.